Hello and welcome to this week's episode for Spy Trader Now. I am your host. My name is Ken, and our model portfolio is up 19.35% year to date. We have a green for the stock market strength color signal. This is an end of the month video, so we're going to do a full monthly deep dive video with all the data that we want to share with you guys. The buy and hold investor for the S&P 500, their portfolio is currently up 18.59%. So our goal here at Spy Trader Now is to beat the returns of the buy and hold investor, and we're doing that by approximately 1%. Here are some past returns for the model portfolio. Last week, the S&P 500, and we use the ETF SPY or the acronym SPIDERS in order to represent all of our percentage gains, and we use that representing the S&P 500. Last week, the S&P 500 gained 0.28%. Now, this is a weekly 5-year chart for the S&P 500. And in this chart, you can see the last pullback of 9.5%. This one was about 6%, and then there was a 10% pullback here in 2023. Here we are right now, right at the old highs. You can see in the thumbnail that we are right at the old highs right now. Last week, we did take on one trade. In last week's video, I told you guys that on Monday, I was planning on taking on an in-the-money covered call, and I did take that on. And here is the exact transaction that I took on. Here are all the trades that we have made in calendar year 2024. And we currently have 3 open positions. We currently hold 200 shares of SPY. We are profitable in that by 15.57% or $15,186. We start the year off with $100,000 and we build the year from there, and then we close it out December 31st and start over again in January. By the way, come January of 2025, I'm planning on taking on 2 portfolios, one of them for SPY and the other one for symbol QQQ, which is the cubes or the NASDAQ 100. So I'm going to be running 2 portfolios starting up next year. Both portfolios on a starting basis will probably have to start both of them at 150,000 because the price of SPY is getting so large that I need a little bit more capital so I can put on a couple of contracts and have some room. Maybe not 150, maybe 125,000, because I need to be able to put on 2 contracts and also have trading capital in an effort to buy and sell calls and puts and do whatever I want to do with options on top of the portfolio. So I need some capital in order to do that as well. So I'll probably do 125,000. If you want to see how I do that, why don't you go ahead, smash that like button down, subscribe to this channel, and ring that bell to be notified when I post a new video. Here is the equity curve of our model portfolio for 2024 year to date. Very slow and steady rising equity curve. This is the equity curve for the S&P 500 buy and hold investor. And here are the 2 equity curves combined on the same graph on a percentage basis so that we can compare the blue model portfolio against the pink buy and hold investor. We want to do this because we want to compare our results against the benchmark of the S&P 500, because quite frankly, if we're not beating the returns of the S&P 500, there's no reason for us to try to venture off on our own portfolio. We might as well just simply buy the S&P 500 and be done with it. Right now, you can see the 2 portfolios are pretty much neck and neck. This is the Fed chair, Jerome Powell. You know what the Fed has done all year long with interest rates? Absolutely nothing. The Fed has held the rates all the way through. The next Fed announcement from the FOMC is going to be on September 18th. The election day is November 5th. The next announcement after September 18th is November 6th or the 7th. I'm sorry. So this one will be after the election. This one is before the election. Generally speaking, it is considered poor taste for the Fed to do anything with interest rates prior to the election. And usually that goes for 2 or 3 announcements prior to the election. So considering that they have done absolutely nothing all year long, and this is the last meeting, originally Fed Chair Jerome Powell said, oh, we're going to do 3 rate cuts in calendar year 2024. Then as inflationary pressures and the strength of the market held on, he just continued to kick that can down the road, and then that changed from 3 to maybe 1 or 2 rate cuts. Then the market over the last 30 days has gotten a little spooked by what's happening, and they're like, the market has basically already baked into the cake a minimum of a 25 basis point rate cut in the announcement of September 18th. Some people even say that the Fed could even do a 0.5 point rate cut, but that 0.5 point rate cut wish of the stock market is kind of waning, because the data coming out is showing that economically the country is still strong. It doesn't appear as if there's going to be a 50 basis point rate cut on this announcement. There's a strong probability that there is going to be a 25 basis point rate cut, and the market has already baked that number into the cake. So it's kind of already accounted for. We have a few weeks to go before we get to that announcement. All right, now here's a chart, a 1-year chart of the 10-year bond yields, TNX. And that is going to be the candlesticks, which are in red and black. Now, the solid blue line here is the S&P 500, SPY, and the black line is TLT, which are 20-year bonds. And basically what happens is when the bond yields dive down, the bonds price goes up. They work totally inversely. You can totally see how the bond yields go down and TLT, the black line, goes up. Now, at the same time, you'll notice that the S&P 500 also likes it when the bond yields drop, because it makes investment capital more attractive for equity investment, which is the S&P 500 or anything in the stocks or something like that. So they both favor falling interest rates. Now, what's happening right now? Right now, you can see that we are down here at, what's the level? 39.11. Okay, so right about 39. I got this green line here because I'm giving you my projection of what I think is happening. I think that originally I thought we were in this trading range, and we are still in this trading range until we break out of it. But what I'm seeing here from the slow stochastics and the MACD rising from a undervalued position, it looks like this is going to jump up to a minimum of the level 40 up to 42. Now this is a 1-year chart. This has happened 2 times in the last 1 year. And I've highlighted the green stick here and here to represent the last time we went from approximately 38 to 42 or thereabouts. And I've also put in these vertical lines to drag them up so we can see what happened to the S&P 500 and to TLT during this time frame. Well, the S&P 500 on this one did advance, because it went from this line to this line, and this time it advanced from this green line here up to this green line right here. Now you'll notice that the TLT absolutely did the opposite. It totally went down from here to here, and it went down from here to here. So TLT has already started crashing down. The S&P 500 is kind of held up. So the S&P 500 is probably going to go sideways to up during this advancement. But TLT, if we wanted to put some capital into a bet buying puts on TLT because it looks like it is going to drop during this time frame right here, while the 10-year bond yields are going to advance. What if my prediction is right, that it advances from its current level of 39 up to about 42. All right, now we are looking at the U.S. presidential election cycle theory, which states, depending upon the year of the election for the president, you have historical rates of return for the S&P 500 and for the NASDAQ 100. Currently, President Joe Biden is in the fourth year of his term. Historically, for the S&P 500, that averages 6.7% of a return for the entire year. Currently, the buy and hold investor for the S&P 500 is up 18.59%, giving lots of downside movement to reach the historical average of 6.7%. Okay, now we are looking at things from the bond market outlook. And the bond market is now saying that we can be in the stock market. We now have falling rates. So when we look at the 10-year yield from 1 year ago, we were at 4.02. Now the 10-year yield has dropped down as of 8/10/24 to 3.96. Well, that is a falling rate. That is a more favorable investment climate for the stock market. Now we still have the inverted yield curve, which is extremely negative for the market. That is not good. That needs to still correct. But the inverted yield curve is showing how you have the rates of the shorter term. This is a 3-month and 2-year yield. So the two-year yield is at 3.87, and here we at 3.83. So the shorter term rate has a higher rate than the longer term rate. What we need is the longer term 10-year yield to be a higher number than the 3-month and the 2-year yield, for it to be a normalized yield curve. We've been like this for a year and a half. Now we are looking at Warren Buffett, the Oracle of Omaha, and we are looking at the CNN Fear and Greed Index. Where are we at? We are currently at greed. And compared to 1 week ago, we were at 54. Now we are at 63. So obviously, this number is rising this way. So the more that you come closer to extreme greed is the more caution you want to put into the market. The more we come to extreme fear, this is the more time where we want to be looking to add more money to be bullish in the market. All right, now we are looking at the seasonality outlook. And the seasonality outlook, well, let's recap last month. Last month, we were in the month of August. In the month of August, going back 10 years, there was a 60% probability that you were going to close higher than when you opened the month. What happened last month? We closed higher than when we opened. For the month of August, we actually closed 2.34% higher. So that was a positive month. So that 60% worked out in the favor. For the following month, now we are entering into the month of September. Well, going back 10 years, the month of September has had negative returns. There's a 44% probability that you're going to close higher than when you opened the month. So for the month of September, those are terrible odds. In addition to that, we have over here the average annual S&P 500 return going back 5, 10, 20, and 30 years. You're averaging between 7.52 and 10.41%. Where are you currently at? For the buy and hold investor, you're currently at 18.59%. Well, that's way above the historical averages. So there is absolutely risk in this market staying long, with the probability with these types of historical averages that there's going to be some type of a correction between now and the end of the year. All right, now we are looking at the month of September, going back 10 years and going back 5 years. Going back 5 years, you can see that for the last 5 years, every single September has had a negative month. Going back 10 years, there's a 44% probability that you're going to close higher. So the odds are in our favor to be short or have short positions for the month of September. Now we are looking at the long-term outlook. This is a 20-year chart. If you look at the dates here, it's going back 20 full years for the S&P 500. It's a monthly chart, and there's a whole bunch of exponential moving averages, which are these lines right here. This is the chart that we're looking at right here, that's in black and red. And you can see the bear market that we had here in 2008 to 2009 with a 50% correction. You had a 20% correction, 19.4 in 2020. There was a 25% correction over here starting in 2022. So this is where we are at right now. And you can see the distance that we are at from here to the moving averages. We're way up here. So we appear to be a little bit stretched according to how far away you are just from the moving averages line here. So it's a little bit of a concern. But generally speaking, you can see that from a long-term perspective, we're in a full-blown bull market. The problem is that you won't know that you're out of a bull market until you start breaking down through these moving averages and you break this line here, which has support here, from here to here, which is that line right there. Well, it's going to take you 20% of drop before you break that line to start showing that you're truly in a bear market. And no one wants to take on that 20% drop. So that's why we have to look at the weeklies and dailies to really determine how we're going to be positioned. But from a long-term outlook, absolutely, we're in a positive environment. All right, now we are looking at the weekly chart, candlestick chart for the S&P 500. And here you can see a 10% correction, about a 6% correction, and then more recently a 9.5% pullback right here. And here we are right at the old highs. You can see here in the thumbnail where we had that drop washout day, came up, and now we are exactly at the old highs, or very, very, very close to them. This here is a negative divergence where you had prices that were increasing while the MACD was showing lower highs. The S&P made higher highs. So that's a negative divergence. But you can see here that the MACD is just getting ready to cross above its signal line. It hasn't quite done that yet, but it is getting ready to do that. The slow stochastics is already above its signal line. This type of activity here, and plus on the histogram on the MACD, you can see how it's showing that it is moving and advancing this way. Well, these are bullish signs. It looks like the S&P 500 is going to advance from this chart that I'm looking at, this weekly chart. I do see bullishness in the stock market. All right, now we are looking at a daily chart for the candlesticks for the S&P 500. And here we've got some cycle brackets. We have this low here representing that low right there. This low here representing that low right there. This low is yet to be determined. We have not seen that low, but it is coming up soon. And the closer this gets this way, the less time that you have to meet that low, meaning that it's a swamp cycle. That's bullish, meaning that the market is so strong, it's not even giving you back anything in order to pull in. I am expecting a little bit of a pullback here, a bottoming, and then it's going to shoot out like this. I'm kind of thinking that the market is going to do that. We'll wait to see how this all plays out. But your exact buy point is going to be right there, coinciding with this cycle low right there. But I have to give credit where credit is due. Do you notice how on the MACD, this black line right here, how it started to wanting to come pass through the red line? But instead of it doing that, it stopped and went, now it's going parallel to the red line. And if this market does continue to advance, well, then this is going to continue to advance without it crossing through the red signal line, that is going to be very bullish activity for the market. So if the market does indeed to do that, that means that this is going to pull up, then maybe flatten out, come down before it continues to go on. So we don't know exactly how this is all going to play out, but we do want to keep an eye on it. So, but what am I looking at right now? We're looking at very close to the old highs, not quite breaching them yet. But this look that I'm seeing here looks like it's actually possibly going to take it out. I want to see how next week, how the stock market action looks next week. I want to see if we pull in a little bit. If we do pull in a little bit, and depending upon how much we pull in, if it does that, right there is your buy point. So let's see if that actually happens. Who knows if that's going to happen, but we want to see. Now we are looking at a ratio chart from the NASDAQ 100 to the S&P 500. That is this black and red graph. The blue line right here, that represents the S&P 500 SPY. Where are we at right now? The ratio of the NASDAQ 100 to the S&P 500 is making higher lows. That is bullish. Right there, it looks like it reached the bottom, and it looks like it's going to want to come up and possibly tag this line right here like it did last time. Well, that's bullish for the market. That if the market is going to do that, that is going to be a bullish activity. We need to see if that's going to continue up. If it does, the S&P 500 will follow suit and it will make advances. Look at what it did last time. The last time that you went from here to here, the market went from here to here. Well, that's fantastic. So that means that the market's going to go from here to up here. All right, now we are looking at another ratio chart from the equally weighted RSP to the normal cap weighted S&P 500. That again is your red and black chart. All right. The lime green, that represents the equally weighted S&P 500. The dark blue represents the S&P 500 symbol SPY. Well, the ratio chart is down here in the toilet. This is a 20-year chart, okay? And for the last 20 years, we basically haven't broken this level right here, except for right there, just a small amount. Now we're down, way down here, and now we're bouncing in this trading range. Well, where are we at? We are at the same area as here and here. Well, that is what is happening right now. And so then that is going to be some sideways activity for the ratio chart. So we want to see and wait for the sideways activity that played out here and played out here. We want that to happen and we want that to go by. The buy point is when you break out of that sideways action. Then if you look at the S&P 500 from that breakout point, moving north. You broke out of the sideways action here. Look at the S&P 500. Excellent advancement before pulling back. So if indeed we are going to be in this sideways moving action, if we do get that breakout point, that's going to be where we want to put on definite leverage and take advantage of those advancements within the market. Okay, what do we have here? We've got the VIX volatility or fear index. There are three ranges. Below this green line here is the ultra low range, bullish. In between the two green lines is the low range, still bullish because it's below 20. Above 20, well, now you're entering into the red zone, which is the upper range, which is bearish. Where are we at right now? We are at 15.00. Well, 15.00 is right there, and we are in the ultra low range. Not only that, look at the action that you see here. You notice how on the histogram it was advancing, but now I can see that it is flattening out. And you can see that on the MACD, how it is not crossing above that signal line and is still pointing down south. That means that there's not energy, there is little energy for this VIX to break up and start doing this thing. At least I don't see it here in the charts. The charts are showing bullishness for the S&P 500. That's what I'm seeing right here. So from this chart, we can go long the S&P 500. Okay, now we are on the Thinkorswim platform. We have symbol SPY up here on the charts, and these are weekly candlesticks that we have here on this 3-year chart. We have our cycle brackets for the major and minor cycles showing right here. You can see that this low represents that low represents that low. A nice clean cycle. You can clearly see it with the midpoint being here and here. Totally can see that. Midpoint right there being right there. This low of this cycle, not quite established yet. Unless this came in early and this low represents that low, it's the stock market. Anything is possible. Maybe that is the low. Or maybe this is going to hit a wall and the next low is going to come in and take out this low and be a lower low. It's hard to say exactly how this is all going to play out. But what we do know is that we are right here at the old highs and we have not surpassed yet. We also do know that on this pullback, measuring the strength of this pullback, I had a target zone at the 78.6 fib being the higher end of it, and we surpassed that all the way basically to the 100% retracement of this pullback. Well, that means that this market has strength, not weakness. So far, this market is showing resiliency and strength. So we want to be aware of that. We also want to be aware that September is a terrible month, but the market is fighting back. Right now, the market is fighting, saying, hey, no, I don't want to go down. I want to go up. Otherwise, you would not have reached a 100% retracement. So we are seeing strength in this market. Now, it is possible that that's not the low, and that was an anomaly of some sorts. Maybe we're going to come down and then reach a low, maybe a higher low than that low right there. So, and then this will be the low, and then you continue on. There's your buy point right there. So right now there is some risk in the market, so we do want to acknowledge that we are kind of in a risky time frame. Are we going to take out these old highs? So you can see how these charts, they give you conflicting information. Let's switch over to the daily and see what the daily has to offer. So let's go over to a 1-year daily, change our cycle brackets to daily, and let's open up and pull this down so we get a nice feel for what we're looking at. Now on this one here, there are 2 valid trend lines that I have drawn. One is in light gray, that's this one right here. And the other one is in dark blue, which is right here. We are trading right in between these 2 valid trend lines. And basically, we're going to continue to trade in these valid trend lines until we don't. So in other words, we want to see which way we're going to break. Are we going to break out this way, or is it going to break down this way? It's going to break one way or the other, and it's going to break eventually. We just don't know exactly when and which direction it's going to go in yet. Next week, the stock market will be closed, observing Labor Day, Monday, September 2nd. All right, now we're looking at a spreadsheet, an Excel spreadsheet that I created just to get a feel for how strong various asset classes are doing, and also the 11 sectors of the S&P 500. And the way that I did it is that if it's a 4 or a 5 on the strength, either the asset class strength or the sector strength, I put green in there. Basically, the more green in the screen, the more bullish things are. We currently have a green here for the asset classes, and of course we have a green here for the 11 sectors of the S&P 500. Now, another thing that you want to compare is you want to compare the current reading to last week's reading. So you can see that across various asset classes, we are losing a little bit of strength, and we did lose a small amount of strength in the 11 sectors of the S&P 500 from 83 to 80. Still strong numbers, and we just want to see how we fare with everything. So that just gives us some visibility to what's happening out there, and it shows you some weak points. Like for instance, right now you can see weakness in silver, energy, materials, and technology. which is surprising because technology is the leader of the market. Well, right now, technology is in the doldrums, and it is also trading below the 50-day moving average. So that is something to be aware of. All right, guys, I just gave you a ton of information. Now we are going to wrap up this video. As of August 31st, 2024, the market summation, according to me, Ken, your friendly host for SPY Trader Now, the stock market is looking like it wants to make a new high, and I think it will next week. September is historically a bad month. I showed you guys that, how we came to that information. And we are already positioned to profit on market declines. Well, why is that, Ken? Because we have in-the-money covered calls. If you don't understand exactly how in-the-money covered calls works, there's plenty of YouTube videos on them. But I've got my plays. I showed you my trades earlier in this presentation. That's the one thing that we do here at SPY Trader Now is we actually show you, we don't just talk about the market, we actually show you what trades do we actually want to put on in an effort to protect our portfolio and also look for profit or potential profit after everything is said and done. So that's what differentiates us apart from other stock market channels that just give you their stock market analysis. But what they don't tell you is exactly what's the proper way to trade this market right now. Now, I put this up here because this is exactly what the stock market is. The stock market is an 800-pound gorilla, and meaning that it will do whatever it wants to do whenever it wants to do it. So even though I talk a game here, ultimately, the 800-pound gorilla is going to do whatever it wants to do. Here is on the seasonality how I showed you how terrible September is with going back 10 years, 44% probability of being profitable. And I also showed you that historically, we only averaged 7 to 10% per year for the S&P 500, and the buy and hold investor is up 18%. That's some serious cake. So you want to be careful how greedy you are when you've already made some serious cake in this market on how much more cake you're going to squeeze out of it before something comes back to bite you. So things to be aware of. That is going to conclude this video. I hope you got some valuable information out of this video. If you have not done so already, go ahead and hit the like button. I got it hidden back here, but there's a like symbol back here. Subscribe to my channel and ring that bell. I thank you and wish you good trading.